Alrighty, so now we're going to look at structure zones and we're going to go through some theory before we hop on the charts in the next lesson. Kind of just wanted to preface this with, in all the time I've been spending mentoring and looking at other people, what I see is people can do the work, they can study, they can go through the course. It all makes sense, it all makes logical sense. They get it, they go through lessons, blah, 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 blah. And then they hop into the live market and basically they'll draw on their zone, they understand the entry model, they'll see price come into the zone, they'll see the entry model present itself, they'll take the trade, and then they wonder why they're taking lots and lots of losses and just getting thrown around. And really it comes back to is that it's not just as simple as identifying, let's say, a zone that broke some structure, drawing on your zone, waiting for price to hit it, come back into it, and then just looking for your entry model. You need to really have a solid grasp of the overall narrative of price action, okay? So I guess what I'm trying to get at is there's a reason why we spent so long just going over market structure and just going over it again and again, looking at three types of structure and trying to give you that really deep understanding of it, because market structure is your base case, it's your framework, it's your building block, it's the bottom of your foundation. And as you're going to see now, we're going to go through very similar diagrams that you should be familiar with from the market structure module, but we're just overlaying supply and demand onto that. We're just adding it in to that framework, because what can happen is when you're in a live market, and I'm just as guilty of it as well, is you can have your zone drawn on. Yes, it's a valid zone, it broke structure, blah, blah, blah. And as price comes into it, you just want to trade it, but actually you need to take into consideration everything. Anyway, I don't want to kind of just keep rambling on, but we'll go through it. And I kind of just want to make the point of, you might be used to some of these diagrams, but I think it's worth going over these examples again and again and really just trying to embed it deep into your psychology and your subconscious as much as possible. So the basics, we'll go pretty quick on this because you should be familiar with this. But essentially, basic market structure, all right, we know price makes higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and higher highs. Now, what we were saying when we were just thinking about market structure, we were saying that this is a weak high. Why? Well, it hadn't done its job, it hadn't broken any structure, okay? So when price is coming back, we know that we expect it to fail. So without even drawing on supply and demand, we know that when price is bullish like this, we know that demand is in control, okay? So when price is pulling back, say at this section, we're gonna look back and we're gonna go, okay, where did the demand step in? So we're looking at this previous leg. Okay, let me reset this. When price is pulling back like this, okay, we know market structure is bullish, we want to get long. So if we look back in the previous price leg within the current range we're within, okay, because we're always just looking at the range we're within. So we know where our swing low is, we know where our swing high is, price is currently here, so we know it's in the swing pullback phase, we know price is bullish and we want to get long, okay? So where are the areas in which we can get long? Well, we look in the previous leg within the current range we are within, okay? And we identify where in this leg are there demand zones, okay? So in this instance, I kept it simple and I've just drawn on one zone. I've just drawn on the extreme zone, all right? Obvious place to try and look for buys. Is this a valid institutional demand zone? Yes. Why? Well, it led to a break of structure, okay? So in its most simplest form, we're looking for those demand zones that led to a break of structure. When price comes back into it, this is where we look to get long. And then we can target what? We can target the weak high, and there may be supply here, right? It might have broken a fractal piece of structure here or an internal piece of structure, but ultimately we expect that to fail. Once price has pulled back to demand, it's fulfilled its objective, it's performed its swing pullback. As we start moving to the upside, we're going to start to expect any supply zones in a way that they're ultimately going to fail until we break the high. Once we break the high, right, there might be supply zones to the left. That's when we can potentially expect price to then pull back, okay, at that moment. So yeah, we'll go into more complex examples in a minute, but essentially bullish market structure, demand is in control. We expect supply to fail. We expect those weak highs to fail and for price to continue. Exact opposite for bearish market structure. Supply is in control, right? Price pulls back up to supply, it's respected, and demand fails. Now, when we have some more slightly complex examples, let's say when price is up here and price is then starting to pull back and we want to look for where is that next swing high low going to form. In reality, there can be 1, 2, 3, 4, 5, depending on how big the range is, there can be multiple supply and demand zones that we have to look at where price could potentially come and pull back to. And we will never know where exactly price is going to pull back to. We never know. We can only identify the zones, look for the confluence that we look for, and try and kind of rank them in order of probability, and then obviously look for more confirmations when price gets in there. Because this is a demand zone here, right, that led to that break of structure. But as we can see, it's already being mitigated, okay? So when we're at this moment and we're looking for where are the demand zones, well, we had this demand zone here, but it's already had its orders filled and it's already caused its move. So what I would do is I would draw it on, but I'm not going to extend the zone any further left because it's done its job, it's there, right? So this is what I was talking about, a series of mitigations, right? It's been tapped into, the orders have been filled, and we move up. So we're starting to potentially form a demand chain now. So this is one potential POI we can look at. It led to a break of structure, and it's part of a previous mitigation. And then we could also look at this zone here down at the extreme, okay? Right at that strong swing low. At that moment, right, price could have pulled all the way back down to here before continuing, okay? And again, we then expect supply to fail. And then likewise over here, right, there could have been a supply zone here. I haven't drawn it on, where we could look for shorts, but it may not play out. Again, has a little bit of reaction, pushes up higher, right? There could have been another supply zone here. In this case, doesn't play out, price pushes through, and in this instance, it comes all the way up to the extreme, right? Where that strong high is with the current swing high, and then we eventually go, and that's when we start to expect these demand zones to fail, okay? Cool, hopefully that shouldn't be too confusing as of yet if you've kind of got the market structure basics nailed down. Okay, so here's another reasonably basic market structure example with supply and demand zones. So again, just think about one type of structure, just think about swing structure, for instance, and just think about one time frame, okay? Don't overcomplicate it any more than that, and let's go through it. So bearish market structure, right, we move to the downside, we have that swing pullback, and then we eventually lead to a break of structure. Obviously, we have a bit of a pullback here. So now our swing low is here, and our swing high is up here, okay? So when price is starting to pull back, we've got two potential POIs. We've got this POI here, this supply zone, right? Because it's at the the pivot of this move that led to the break of structure. And then we also have the extreme as well, okay? So there's sort of two main supply levels that we're looking for price to pull back to. Again, we never know which one it will be. There's other confluences that we can use, such as premium discount and liquidity stuff that you're gonna learn in the future lessons. But essentially that's two levels. Price ends up pulling back, Price ends up pulling back into the zone here, right? And then again, we get another break of structure. So let me get rid of these drawings. Once we break that level, again, we're between this swing low and this swing high, two potential supply zones. We've got this pivot that led to the break of structure, and then we have the extreme as well. Price ends up pulling back into here and then continuing down. So again, this becomes our strong high, this becomes our low. Price comes into that supply zone, we can look for shorts and we can look to target the weak low, but at some point that's gonna fail and the trend is gonna change, okay? Now at this moment, when the trend changes, okay, and we're looking for longs, what do we expect after a break of structure? We expect a pullback on that time frame. So what can we do to expect when that pullback may be about to start? Hopefully, if you looked at the market structure modules, we can look for shifts in structure. So we can look for bearish changes of character, right? Or ideally, we get a bearish IBOS, right? So that's what we look for as a piece of confluence for structure. But another thing now that we can use is we can use supply and demand to try and anticipate ahead of time where that pullback is going to kick in, okay? So at this exact moment when we break through and we look left, there are no supply zones. So what we want to do is we want to look for where is the nearest and significant supply zone. It's going to be this supply zone here. So what I'm going to do is I'm going to draw it across, okay? Now, do you see how, I'm going to make it an empty box just to kind of show you that now this becomes what we call like, I don't really have a name for this, but we could call it like a pullback zone. Because previously, I'll just bring it back, when we were over here, okay, when price was down here, and this was our swing high, and this was our swing low, and we were bearish, we were looking to potentially short this zone and this zone. And if price comes into it, we're looking for those big moves, right? We're looking for the continuation of the trend. But now we're not in a bearish trend anymore. Now we're in a new bullish trend over here. So when we now look at this zone, we don't view it in the same way. We don't view it as price going to come in and continue down. We simply view it as an area in which a pullback can start from, okay? Now, some of you, that might seem obvious, but you'd be surprised at how many times you can be in a live market and people can be treating them in very, very different ways and managing their expectations wrongly, okay? So we look left to a significant zone, and now the supply zone simply becomes a catalyst to play that pullback, okay? So likewise, then we pull back, and then we're looking for demand zones. So we've got one here, and there'd potentially one at the extreme, and there's two possible levels in which that high low could form, okay? In this instance, it forms here and we break up to the upside. Again, when we break, we can start to look for structures to shift to the downside. So we can look for bearish chocks or bearish IBOSes to give us that first signal that a pullback is occurring. But we can now also use supply and demand. As soon as price breaks up here, we want to look left and we want to look for where is the nearest significant supply zone. Now there is one here, but we've already had a mitigation of that zone, okay? We've already filled up a lot of the orders because it led to that movement here. Now, when price is at this moment, right, there might still be some orders within this zone, okay? Because obviously it only taps the edge. So there might still be some orders from within here. And what you might see in the market is you might see a little bit of a pullback. But typically, not always, but typically, the zones that are going to cause that big actual swing pullback to occur are usually the ones that are completely unmitigated, the ones that are completely fresh, okay, normally. So if I was looking to play counter trend, which is obviously can be a bit hard and a bit more risky, I'm going to have a lot more confidence doing it. Not when price is currently here in this zone, because that's already filled up a lot of the orders. It's already absorbed the supply within it. It's already caused that move. I'm going to be more concentrating on this zone up here, okay? So I'll be aware of it and I'll have it in the back of my mind, that potentially price could reverse from within here, but it's much more likely to be a completely unmitigated zone up here, okay? And then we can play the pullback down into demand. And then obviously we know that demand is in control and we expect price to go there to the upside.